hope is that in our time together today, we will be able to wrap up our discussion of the procurement process and be ready to move into the fulfillment process. The lab work that you are working through right now is actually pretty timely. You know, a lot of the lab work that we've done this semester, you do the lab work and then we talk about it weeks later. But in this instance, one of the things that we've talked about recently has been goods receipts and stock transport orders and other things of that sort. And that's exactly what you're working through now in the lab work. So many of you have finished it already with success, and so hopefully that has been helpful to you. For those of you still working on it, hopefully you can connect up the things you are doing with the things that we have been talking through. So to jump back into our discussion of the procurement process, we had just finished up discussing the first set of steps in the process. We talked about some of the triggers to the process. We talked about how it fundamentally commences with our having determined that we need something, and we memorialize that in a purchase requisition, which serves as the triggering document for this overall process. And one of the first questions we run into is, do we know where we are buying this item that has been requisitioned? And as we talked about last time, sometimes companies have contractual arrangements with suppliers, and so we know that a product of this type is always going to be bought from this particular supplier. But in other instances, we don't know that, and so we may send out a request for a proposal. Sometimes that's called a request for quotation. Fundamentally, same idea there. We're looking for someone to give us prices on particular products so that we can evaluate them. They send us a quotation, and we then will enter those facts into our system. And we may, in fact, put in many, many quotations and then have the system do the analysis of it and help us decide which supplier is actually the best one for us to send the order to. The ultimate outcome of that is we know who we're going to order it from. We've selected the vendor, and then we are ready to issue the purchase order. And I think that is where we left off when we were last together. So the next step in the process is, after presumably the passage of some time, the materials come in. We have goods receipt. And as I mentioned a moment ago, in your labs that you're working through now, you've seen this. The idea that goods receipt is memorialized in a document called a goods receipt document. And the idea here is really straightforward. This particular step, we know it's time to begin goods receipt when the vendor starts backing its truck up to our delivery dock and unloads materials. Okay, now we're ready to receive them. And so there are a lot of things that go along with this step in the process from a business rules case. Remember previously we talked about things like setting tolerance levels related to under delivery and over delivery. So all of those things are going to be checked at this point. The task of the people that are doing this work is to verify what it is that they have been getting in, count the boxes, make sure it's the right item, and then they will memorialize what they have received in this goods receipt document. Now typically, although we would not necessarily have to have this in every instance, but typically the supplier will send along with the shipment a delivery document or a packing list that will tell us exactly what is in this particular shipment, because the idea there might be, if we have an ongoing relationship with the vendor, at any given time we may have multiple purchase orders out with that vendor. And of course, they don't want there to be confusion because they want to get paid as quickly as possible, and any confusion on our part may delay their payment. So one of the things that they will make sure that they communicate to us by way of these delivery documents and packing lists is which items are in this shipment and what purchase order are they related to. When we get to the selling process, we'll talk about this in more detail, but the basic idea here is you could have one purchase order that might get split up into multiple deliveries. You could have multiple purchase orders that could be put onto one delivery, or you could have portions of multiple purchase orders that are all part of the same delivery. So this can get fairly complicated from a information handling perspective. I would observe to you that in the lab work that you're doing now, what you have been doing with the goods receipt is you've been going in and starting a goods receipt document and then just copying things from the materials documents, copying things from the transport orders, copying things from the purchase orders onto the goods receipt, and then saying, yes, those things are okay. Well, in a more complex situation, we might only be copying some of the items over. And so it's important that the people that are doing this work exercise great care here. There are, in fact, multiple documents that are created by the system. And this is an example of where we have to configure the system to behave the way we want it to behave so as to make the life of the workers a lot easier. You know, the fundamental thing that's going on here is you're going to have workers working on the loading dock, counting boxes and punching that into a computer and pressing enter, and that's really all they're going to be trained to do. They're not going to be trained in how to debit and credit accounts in the general ledger. They're not going to be trained in those kinds of more sophisticated things that we want to have happen. So the key here is we configure the system so that when they put in the goods receipt document, other things happen automatically. So they will key in the information that will be the basis of the goods receipt document, but then apart from that, we're going to see a material document generated and an accounting document created. We also are going to see the purchase requisition and purchase order updated. And this is a good place for us to observe that the purchase requisition and purchase orders, these are two examples of a class of documents that we see in the system that would be considered live documents. Now, the idea behind a live document is it, of course, gets created at a given point in time, but then it's going to be updated as well as we have new information. So, in fact, we started with a purchase requisition, and then that resulted in a purchase order being created. When the purchase order was created, the document number of the purchase requisition was put on that purchase order, but similarly, the purchase requisition was updated to indicate that a purchase order was generated based on that purchase requisition, and the PO number is there. So ultimately, what we are going to see created by this process is something called the document flow. And the key thing here is we want to be able to, should we need to, locate any one document in the document flow and then follow it to subsequent or previous documents. You know, you could imagine that the entire purchasing process has finished for a given item. We might go in, look at the purchase requisition, and then want to go and look at the purchase order, and then want to go and look at the goods receipt, and then want to go and look at subsequent documents. So these are live documents that get updated as the process continues. So the goods receipt document has the items on it that you see here. Fundamentally, what you're going to see here is we're going to verify the materials, the count of those items, that they are in fact what we wanted. And then once that document is saved, that of course is a material document is going to be generated. An FI document is going to be generated. That FI document will update the general ledger. The purchase order gets updated. The material master may be updated. We'll talk about why that is in a moment here. If we have quality management turned on in our system, the inspection process may be triggered at that point. There's a lot of stuff that happens here as a result of goods receipt. So even though the logistics of this are pretty straightforward, it certainly warrants us talking about the different steps here. So the goods receipt document itself, it's just going to say, okay, here's the purchase order number, here's the materials off of that purchase order, here's how many we got. Well, this is all, I'm sorry, I'm getting ahead of myself. This is what's on the purchase order. The purchase order has a purchase order number, materials ordered, and the quantity ordered, and those are going to be copied to the goods receipt. Similarly, we may have a delivery document from the vendor that's going to say how many materials were delivered and the quantity delivered. And so the user's going to put in, yes, that's accurate. They're going to record the numbers. And then things like what receiving plant and storage location they're actually sending this to. And we talked before about goods movements types. They're going to record the movement type here of a goods receipt into inventory. So that's that document. Well, two other documents get created here that are of great importance to us, and that is a material document and an accounting document. Now, this is a bit of a review from what we talked about last time, but it's a good place to reinforce this. Material documents focus on quantities. So when we generated a goods receipt a moment ago, we may have indicated that we just got in 500 t-shirts. Well, that's going to result in a material document that says on such and such a date into such and such a particular plant and storage location, 500 t-shirts have just come in. This material document also results in what else being updated? Where can I find the quantity of how much of a material I have on hand? The material master. So this material document, when it gets created, is going to inherently update the information on the material master about this particular item. The other document that gets created is the accounting document. And the key here is the material document focuses on the quantity. The accounting document focuses on the money. And so notice the information is segregated in exactly that fashion. The accounting document doesn't give us any material quantities, and the material document doesn't give us any dollar references. So we separate the recording of quantities and the recording of money across those two particular documents. So all that we're going to see on the accounting document are dates and general ledger postings. And we'll cover that in more detail on the next slide and show you how those things are going to play out. But this idea that the material document records quantity and the accounting document records money is a key fact and something that should make it very logical then for us to understand that at goods receipt, those are two kinds of documents that are going to be created. Goods receipt has a very important fact associated with it. This is the first step in the procurement process that has a financial accounting impact. Because up until now, you recall, we haven't talked about debits and credits. We did talk about commitment management and how the system might keep track of certain values for us if we've turned commitment management on. But even with commitment management, we're not making postings to our general ledger. When we have goods receipt, we do now have to indicate that we have a transaction here going against our ledger. And the idea here is really straightforward. We now have something that we did not have before. So in most instances, what we are going to see here is if we are talking about valuated stock, if we are talking about stock materials, which means that these are things that are going to be valued as an asset, we are going to be increasing the value of an asset and then making an offsetting accounting posting. So here's the way this plays out. We, in this instance, are debiting trading goods, which reflects that we now have, in this particular example, $7,500 more in trading goods than we had a moment ago. Now, how do we know what account gets debited in this situation? How do we know that? Who can walk us through how the system's going to do this for us? Because it's a key element in this overall process. Okay, it's an asset. So how does it know what account to debit? Okay, and what about the material master? Okay, we're headed down a good pathway. Account determination is exactly right. Let's back up here and look at where we talked about this before, because it's very important that we can connect these things up. Back here when we were talking about stock materials, we said that stock materials have a material master. The material master designates a valuation class, and the valuation class maps the material to an account where the material value is reflected. So if we go back to what we were just talking about here, what's going to happen is the goods receipt process is going to, of course, designate the materials that were received. The material master will be consulted because this is a stock item. This is a valuated stock item. We track it as an asset. We consult the material master. We find out the valuation class associated with this material. We find out what general ledger account is associated with that particular valuation class, and we debit that account for the value of what it is that we have taken in. So, knowing that that's the debit, and remember the idea here is we are increasing the value of an asset. So the offsetting credit is to an account we have not talked about before, the GRIR account, which stands for goods receipt / invoice receipt. Now, this GRIR account is an example of something that we talked about previously, which is this is an example of a clearing account. This is picking up the fact that we just got in the materials. So if we ever see a credit balance on a GRIR account, we know that we've gotten in materials that we have not yet paid for. You will notice a couple of very interesting things at this point. My vendor account gets no postings. Accounts payable, no postings. My bank account, not touched at this point. At goods receipt, what happens is I debit an asset account and I credit goods receipt, invoice receipt to memorialize the fact that I got the goods receipt, part of goods receipt / invoice receipt. Very important sequence here to realize, and keep in mind that literally somebody on the loading dock keys in what we just got in, presses save, and this happens instantaneously as a result. Okay? So that's an example of information going into our general ledger without the person doing the work necessarily even realizing that that happened. Any questions about that before we talk about variations on it? Suppose this was not valuated stock. Suppose this was a consumable material. What would happen then? Well, on the purchase order, we would have designated a cost center or an expense account associated with this. And so it might be that the debit here would hypothetically be to, let's say, supplies expense. We are always going to be crediting GRIR. The only differences here is we're either going to be debiting an asset or we're going to be debiting an expense. Questions about this? So this right here makes a really, really good test question. So we just received goods. What is all the stuff that just happened? Number one, the material master was just updated to show how much of this we have. And if it's a valuated material, the material master was updated to show the value in dollars or some other currency of our inventory. Now, as we were just talking about, if this is a consumable material, we may not have a material master. So if we have a material master for a consumable material, it's going to track the quantity but not the value. And that's an important fact to keep in mind. Remember, we may have a material master for a consumable material, but even if we do, we don't track the dollar value of it. We just expense it right away, as we just observed on the last slide. So one of the things that happens here is our material master gets updated. The second thing that happens is an FI document gets created. This is exactly what we were just talking about here. And what's going to happen here is one of two things. Either the FI document is going to reflect debiting an inventory account to reflect we now have more and crediting the GRIR account, or we're going to be debiting an expense account and crediting the GRIR account. Those are only two options for how this is going to be captured in a financial accounting document. There will be a material document created. We looked at that a couple of slides ago. And the fundamental thing that the material document is going to be telling us is, where is this stuff going? What's the unit count and where is it being put? So it's being put in plant 27 in storage location A26, okay? So a material document is going to be created that's going to be tied to a goods movement that says this is where that stuff was put. If we have quality management turned on, then the inspectors are going to be notified that they have work to do. Now, the way this works is if quality management is turned on, an inspector is designated on the material master. And that inspector can go into the system and run a transaction that shows all of the things that he or she may need to inspect. And so they may grab their clipboard and go down to the warehouse and look at the items and, I don't know, test one of them or measure it or do whatever it is that they need to do to decide whether or not the item is acceptable. Keep in mind that if quality management was turned on, this material document recorded that we put this into inspection. And so goods and inspection are going to stay with that particular stock status until the inspector validates them. There will be a transfer requirement to the warehouse if we're using warehouse management. So in this situation, maybe we're going to take it, and this is exactly what you're doing in your current lab sequence. We're saying go and put this in this particular storage location. So notice we could have done the materials document and just said, hey, this is going into this storage location. Or if we have this quality inspection going on, we may put it somewhere for it to be inspected, and then after that it gets moved into storage in a warehouse, depending upon how we are tracking our inventory with warehouse management. Typically, a hard copy of the goods receipt slip will be generated. You know, that's optional, but a lot of organizations still do keep certain things in paper format. And so memorializing that something has just arrived is very typical. And in fact, it would not be unusual in a lot of organizations for that to be mailed to the person who actually requested the item or ordered it by way of intercompany mail. The person who ordered it is going to receive notification that their stuff is in. Now, in most organizations, you would expect that this would perhaps happen by way of email. But as I just observed, this could happen by way of hard copy. You don't actually set this up in any of your lab work, but the idea here is pretty straightforward. We can trace every item that came in back to a purchase requisition. That purchase requisition tells us who ordered it and where they're located, and so we can send them notification, hey, your stuff's in. Yes, sir?
With regards to the quality inspection, what if in that process there is no observed that some material that is either defective or not made acceptable to quality? Does that allow for returns and that kind of thing?
Yes, and in fact what we would do is there would be a material document generated related to the return. Something called a return slip is actually what's going to start the process rolling here. That will actually result in accounting postings of its own. We won't necessarily undo this, but we'll make a complementary posting to indicate that some of this is actually going back. I don't require you to know that. I don't have a slide related to that, but that is in fact the way that would play out. Yes. And the reason why we don't undo this is we still want to memorialize that they made a delivery on a certain date. We just want to also memorialize that 3 days later we sent it back to them. And then the last thing here is, as we observed before, we update the live documents associated with this process, which is we update the purchase order history. Really, I think that should say we update the purchase requisition and purchase order history updated, because both of those documents get updated. I think this is a typo on this slide. So a lot happens at goods receipt. This is kind of the focal step in the procurement process, which is kind of makes sense since the whole point of the procurement process is to get stuff in, and this is the step where that actually happens. So if we go back to the overall progression here, now we have goods receipt. We're getting close to the end here. The next thing we're looking for is an invoice. So what happens when we get the invoice? What is presumed is that in most instances, the goods will show up and the invoice will either basically show up with the goods or show up shortly thereafter. But we need to make sure that our system still works if the invoice shows up first. So in fact, what we could see happen is we could go from purchase order to invoice receipt to goods receipt. And what we're going to see is everything will still work out just fine. The order of these two steps right here could get flip-flopped just based on the way reality works out. So the trigger for invoice receipt is I open up my mail or open up my inbox or whatever have you, and lo and behold, there's an invoice from a vendor in there, okay? So my task now is going to be to validate that this invoice should be paid. And I'm going to do that by way of a three-way match. And so let's talk about that for a second. Before I pay an invoice, there are three things that I want to check. I want to check the purchase order, I want to check the goods receipt document, and I want to check the invoice. Now, why do I check the purchase order? What key facts am I pulling off of the purchase order? Okay, price, quantity, There are other important facts. What else? The items themselves. And there's one other thing. Very important. Vendor makes sense, yeah. Wasn't what I was thinking of, but yeah, for sure. That's going to be there. That's going to be important. The payment terms. Remember when I sent the purchase order, I might have said that the payment terms were 210 net 30, meaning that I get a 2% discount if I pay within 10 days. So I want to make sure that the invoice that I have matches up with what the purchase order said. I want to make sure that the prices are right, the quantities are right, the items are right, obviously that the vendor is right, and I want to make sure that payment terms are accurately reflected. So the goods receipt, what am I primarily focused on here? Why do I have to check this? Yeah, to make sure that the quantity that I got is consistent with what I ordered. Now, remember what we observed previously, which is we have tolerances defined for under delivery and over delivery. So I might have ordered 100 pounds of something that's denominated by weight, and they might have delivered 105 pounds, which let's assume is consistent with my tolerance level. So when I check the invoice and see that it says this is 105 pounds, I ought not be surprised. And the system's going to look at that and say everything's consistent with the rules that you've established. But if I order 100 pounds and my delivery tolerance is 5%, and I get an invoice, or let's say goods receipt, let's say they try to receive it with 125 pounds, that's going to be rejected, and we're not going to accept that shipment because it's an over delivery. And in a lot of cases, we'll just tell the truck driver or whoever, take that back. You know, we're not accepting that item. But nonetheless, certainly if the invoice shows 125 pounds and we ordered 100 pounds, now we have a discrepancy here. So the whole point of the three-way match is to make sure that these documents are consistent. Now, they don't have to be identical, because as we just observed, the purchase order might specify a quantity that's different from the invoice, but that's okay, assuming that the goods receipt verifies that, in fact, a different quantity here is appropriate. So there are a couple of different ways that we could handle this, and this might strike you as kind of odd here. Suppose we have the following scenario. Suppose that let me get all this ink off of here. Suppose we order 100 units of something. And we haven't explicitly talked about this, but I think it's referred to in your reading. The vendor doesn't have all 100 units. They back order some of this. And so when the truck pulls up, it delivers 80 units. And then along with that includes a slip that says 20 more units will come in by the end of the week. Okay? We get an invoice for 100 units. What do we do? And the answer to that is, it depends on a company. What a lot of companies do is they do what is called purchase order based invoice verification. And let me explain the logistics of it and then explain to you why we do it this way. If we have a purchase order based invoice verification, we have a bias towards paying the invoice as long as it's consistent with the purchase order. So in the scenario that I gave you, we ordered 100 units, they delivered 80 units, they sent us a bill for 100 units, and we sent them a check for 100 units. Now you might say, why in the world would we do that? So my question to you is, why in the world would we do that? What can you think of? Anybody have any ideas? Okay, what I like about what you said, and I don't know that I've ever heard it described this way, is one-shot posting, which is we don't want to make work for ourselves, okay? We want, every time we have to send a check, there's a cost associated with that. The trivial part of that is the stamp on the check, but the process of printing a check, the human labor that goes into that. There's lots of studies I've read over time that, talk about every time a company sends out a check, just that process costs them $10 or $15 or whatever have you. So what many organizations will say is, we order 100 units, you send us an invoice for 100 units, we pay for that, but of course our system knows that you still owe us 20 more units. And we're expecting that you're going to deliver those. And if you don't, our system is ultimately going to trigger us to the fact that we have a shortage associated with a particular vendor. But if this is a vendor that we do a lot of business with, it's not worth it for us to send out 2 checks to settle 1 invoice because of partial delivery. So many organizations will engage in purchase order-based invoice verification, where they look at the purchase order and they look at the invoice, and as long as those things are consistent, they'll trigger payment. But then, of course, they are still going to check and make sure that the items were received and do a reconciliation behind the scenes. The other scenario is probably what most of you would think would be typical, which is we look at the goods receipt too. And we make sure the goods receipt is correct, and we pay based on the goods receipt. And that's called goods receipt-based invoice verification. So companies can elect to do either of these 2 things, and in fact, they can vary that from order to order or from vendor to vendor. It is not unusual for some companies that do a lot of business with a given vendor to send that vendor 1 check a month for multiple purchase orders and to consolidate in that fashion just to simplify things. So that's the kind of thing that we're talking about here. If we have an ongoing relationship with a vendor where in some instances they may be delivering stuff to us every day, and we know that they want to keep our contract and maintain our relationship, so they're not going to try and short us. We're still going to keep track of everything by way of goods receipt documents and know what we still are missing at any given point in time, but we don't want to put a lot more work on the people in accounts payable than we really need to. So the idea here is that we're going to be looking at the purchase order, the goods receipt document, and the invoice, but the logic of what we do is something that we in fact can configure. And let's go back to something I mentioned a moment ago. At the time the invoice comes in, we may not have even had goods receipt yet, which that would then allow us to do purchase order-based invoice verification because, we know the items are going to show up next Tuesday, but we want to go ahead and send out payment now. Maybe the vendor actually requires it in some instance. And so this allows us to handle those situations as well. This slide right here pretty much just captures what we talked about a moment ago when I asked you, what we're going to be looking at in terms of things coming off of these different documents. So we had 1 accounting posting at goods receipt. Here's our 2nd accounting posting, invoice receipt. Now the thing here is these are the numbers these are the postings with the 2 next to it. We credit our vendor account, showing that we now owe this vendor X dollars. That results in an automatic posting to our accounts payable reconciliation account for that same amount. So that's the credit side of this. What's the debit side of this? a debit posting to the GRIR account. And you will now notice that these two things cancel each other out. That tells me that I have goods receipt and I have invoice receipt. If I have a debit balance on that account and no credit, I know I got the invoice, but I don't have the goods. If I have a credit but no debit, then I know I have the goods, but I don't have the invoice yet. But when I have corresponding postings here, and keep in mind, because of what we talked about, there may be slight dollar differences here. At least if I get close to zero, then I know in that instance that it's okay for me to trigger payment. So the second step in the purchasing process with an accounting implication is getting the bill. What happens when I get a bill? Well, what I do is I actually record it in my system as an invoice. Now, in fact, if I have my computer hooked up to my vendor's computer, they may essentially trigger this document creation in my system, independent of any one of my employees doing this. What will happen here is the material master valuation information gets updated. Now, what's going on here? Well, remember, we have to take into account, depending upon the material master and how we are tracking this, how the cost of this is calculated. Are we using a standard cost or are we using an average cost? If we're using an average cost, the material master valuation information is going to be updated based on the price that the invoice shows that we paid for this. Purchase order requisition and purchase order history updated to show that I got a bill, and here's the bill. We can look it up in the system. And then, as we just observed a moment ago, there's going to be an FI document. And the FI document is going to have us crediting the vendor account, showing that we have a liability, and debiting the GRIR account. So not as many things happen when I get the invoice, but this first one is very, very important if I'm using moving average pricing. Moving average pricing, moving average valuation of a material gets updated when I get an invoice associated with that material. We are just about at the end. The next step in the process is we have to pay for the stuff. Now, we can, in fact, go into the system and manually pay a bill. But one would expect that the reason why we have invested all of this money in a computer system to help us with this is that the computer is going to make this a lot easier for us. And so, in fact, if you worked in accounts payable, you would certainly not be manually drafting checks all day, nor would you likely be going in and examining individual transactions. What you would most typically do is run a transaction called a payment program. And the payment program would step through all of our invoices and look at the status of the GRIR account associated with that and come to the conclusion of should we pay or not. Now, many times in an organization, there will be human input into this process as well. For example, if I order something here at ETSU that costs a lot of money, before the university will pay for it, they will ask me to validate that everything's okay with the item. And so the system may in fact be set up to allow for things like that to happen, and the payment program would be sophisticated enough to check and make sure that in fact all of the approvals are in place and that yes, we do want to pay this item. There's not much to say about this except to say that what this will also do is, of course, it's going to look at the invoice from the vendor. It's going to look at the payment terms and payment methods, It's going to verify the input that's coming from the user that I just talked about related to approvals, and then it's going to send payment. I'm familiar with a company that a couple of years ago did a very interesting analysis and realized that, first of all, for companies, most companies will keep their money, even their working cash, in an interest-bearing account. And so if they, for example, get an invoice that says 210 net 30, I don't know that we talked about this, but this means that you get a 2% discount if you pay within 10 days. Well, that means that if I pay on day 1, I get a 2% discount. If I pay on day 10, I get a 2% discount. Well, why should I be eager to pay on day 1 if there's no incentive for me to do so? And this one company that I'm familiar with that looked at this, they discovered that they were doing a really good job taking advantage of these discounts, but that they were paying too early. They were depriving themselves of the float here between day 1 and day 10, and this would be exactly the kind of thing that would be a great word problem on an accounting test. You know, if we had this much payables in a given year, and on average we paid on day 2 when our terms were 210 net 30, how much interest did we lose? And in this case, the company realized that they were losing tens of thousands of dollars a year in money that they would have accrued from their bank in the form of interest by paying too early. So one of the great things about electronic payments is I can take advantage of 210 net 30 by sending the electronic payment on day 10. Or if you will, on day 10, you know, at the end of day 10, you know, early enough so that I get the advantage of it, but I hold on to my money as long as possible. So one of the things that we would want to do in our payment process here is make sure we have this set up to make sure all of our bills are paid on time. We take advantage of all of our discounts, but there's no prize for paying early. And so the payment processing program will help us meet our goals here based on how we have that configured. So now we're here. This is the last step in the process with a financial accounting implication. And we'll just go back through the whole thing here to make sure we got it all. When the goods came in, we debited our asset account for those goods, and we credited the GRIR account. Then the invoice shows up. When the invoice shows up, we credit the vendor account, which results in an automatic posting of a credit to accounts payable, and we debited the GRIR account. We now observe that these cancel each other out. Essentially, this guy is out of the picture now. We run our payment processing program, and it says, yeah, you can go ahead and pay. Well, what do? We credit our bank account because we now, are parting with money, and the corresponding debit goes against the vendor that we are paying, which also results in an automatic posting to accounts payable reconciliation. So notice that when everything is said and done, the only thing that's left with a balance on it is we now have more of an asset and we have less cash. And in fact, as an aside, that's exactly what would have happened if we had just bought this for cash to begin with. But when we buy on credit and with extended payment terms, that's where all of these other accounts get involved in the process here. Questions? So there's the process. We've talked about all of the steps. We did not really talk about CO documents because we're not really talking about cost accounting very much, but I'll just make the observation that I did previously, which is that cost accounting documents really just take information from financial accounting documents and pull them into the context of cost accounting. Where this is going to be most relevant in what we have just talked about is when we were buying things that were being expensed immediately. When we were buying consumables, that would be captured in a cost accounting document. But otherwise, everything else that we see here are things that we have talked about. As far as the reporting associated with the procurement process, we have a lot of data sources. Obviously, there's a lot of organizational data at work here, of which perhaps most notably is the company code, which is capturing the financial accounting implication, plants and storage locations, which are capturing where the materials are going. We have material masters and vendor masters, which are very involved in this for, I think, obvious reasons at this point. And then the transactional data associated with this process. We have purchasing documents. This is our purchasing requisition and our purchase order. But then beyond that, we have material documents. We saw material documents get created at goods receipt, for example. We have accounting documents. Accounting documents got created at goods receipt. They got created at invoice receipt, and then they got created at the time of payment. And then we have the invoice, which obviously came into play in the invoice receipt step of the process. So this slide just kind of collapses into one, a summary of all of the different things that are involved in this process. This is something that in an organization will probably be done on a daily basis, and depending on the size of the organization, maybe even hundreds of times on a daily basis as we're buying products from a wide variety of vendors. What about the types of reports that we can look at in the system? One of the most important reports likely in our organization will be just keeping up with the status of things. Hey, I sent you a purchase requisition last week. Can you tell me what's going on with it? Well, the people that work in purchasing would rather not get tons of those calls every day. So to the extent that someone can log into the system and see the status of their purchase requisition, they don't need to make that call. You know, they can see that the purchase order went out last week. They may, depending upon, remember we said that we send the purchase order to the vendor and the vendor replies. If our system is integrated with the vendor, we might even see in the system that the vendor expects to deliver this next Tuesday. But even if we don't see that, we know when the purchase order was sent out. So instance reporting just allows us to look at the purchase requisition and or purchase order, and because, as we observed before, because these are live documents, they're going to inherently give me a play-by-play of where we are in the process so that I can know what to expect. There are lots of transactions that give me online lists. You've seen this in your lab work. You can go in and search for and list all of the purchase orders in the system, all of the invoices in the system. And we can, of course, search using various criteria. Show me all the purchase orders associated with this vendor. Show me all the purchase orders associated with this material. We can limit those things. There's all kinds of reports out there like that. There are work lists. If I worked in accounts payable, I would be able to look up and see, okay, what are all the invoices that are open to be paid right now? If I worked in purchasing, I could run a transaction that would show me what are all the requisitions that are in the system that have not been acted upon. So we see a lot of those kinds of things that are just very logical. And I'm not showing you these in the system because a lot of these you will actually see in the context of your lab work, or they're things very similar to what you have seen before, and so I don't think we necessarily need to look at it. We do have what's called the logistics information system. That is a part of the standard SAP ERP product, which is where I could look for some very basic kind of analytics associated with purchasing. And a lot of this would be things focused on how good is my vendor at delivering on time? You know, I specify on my purchase orders the delivery date. In a lot of instances, you know, if we're doing just-in-time delivery, if a vendor doesn't deliver on time, we could discontinue our relationship with them after just a couple of slippages. In some organizations, we put down a date and we're much more flexible than that. Well, the logistics information system is going to allow us to do things like, you know, let's look at all the purchasing done by my purchasing group. And then let's drill down and look at this on a vendor by vendor basis. And then we can look at it, you know, by the month, by delivery date. We just have the ability to look at these transactions and do some drill downs on it to observe the success of the execution of our purchasing process here, where we can look at our overall purchasing. And a lot of organizations will follow this up with things like ABC analysis, where we apply a variation of the 80-20 rule, where we might realize that although we have perhaps hundreds or thousands of vendors, there really are a select few vendors that are getting most of our business, and therefore we would want to manage our relationship with those vendors much more tightly. ABC analysis would allow us to classify vendors as being kind of prime vendors, and then second tier vendors, and then third tier vendors. And we can use flexible analysis to help us do those kinds of clarifications, and also to help us search out alternate sources of supply if a given vendor happens to be out of something at the time we order it and we need to find another supplier. And that is the end of the procurement process. The next item on our agenda is the fulfillment process, and we will plan to start into that when we get together on Tuesday. But before we head out for today, are there any questions you folks have about anything? All right, we'll have a good rest of the day and a good rest of the weekend, and I will look forward to seeing you guys when we get together next Tuesday.